All right, what's going on, y'all? Welcome back to Average Money Works. Thank you for tuning in. If this is your first time to the channel, what I'm doing is taking $2,100, using that money to do all the different types of option strategies and investing strategies that you can use the stock market for to create passive income, generate additional income. And what I'm doing is using this to pay off my student loan debt, my credit card debt, my car, and reach financial freedom a lot faster. So I'm using this to add to my regular bill paying. So real quick, none of this is financial advice. I'm not a financial advisor. This is just me documenting my own progress. If you do choose to invest, invest at your own risk. If you have not started an account yet, there's a link down below. Click that link and you'll get a free stock just for signing up. So make sure you guys click that link. If you're not subscribed yet, make sure you subscribe so you can follow along with me as I go along this journey towards financial freedom. So real quick, right now, I'm just going to go over my account at the moment, the options that I'm in, the stocks that I have, the shares that I own, and game plan for next week. So right now my account is at $2,398.62. So we're up about $80 from last week. Right here is my solo put. So what I did was I sold a put, which basically means that I'm agreeing to buy the shares at $6 a share by the end of today, the 15th, if solo falls below $6. So if it falls below $6, then whoever's on the other end of this contract is going to sell me the shares at $6 a share. But because solo went up in price, the share price, the value of my contract went down because the likelihood of somebody picking up this contract are pretty much zero at this point. So the value went down. So if I wanted to close this position and get my money back, I'd only have to pay $1 because the value of the contract is low. But what I want to do is just let this thing expire worthless so you guys can see exactly what happens when it expires worthless. And I want to collect the full $40. So if I closed it and paid $1, I'd have to pay $2 because I got two contracts. So I'd have to pay $2. And basically that would mean that I made $38 off of this transaction, this contract. And then I could have opened up a new put for the next expiration date and collect that profit, but I decided just to wait, and I'll do that on Tuesday when the market opens back up. The market's not open Monday, so it's going to be open on Tuesday. So hopefully if solo stays here or goes down, then I'll be able to get a decent price for these contracts. But if solo goes up, then it might be a little bit cheaper, which means I won't make as much money up front. So that's the solo play. And as you can see now, this is now after hours, and my solo put is gone because the option expired worthless. So I'm going to let this thing settle for a little bit. Maybe by the end of today or tomorrow, my $1,200 will be put back into my buying power. And that $1,200 was what I used to open up those two puts. When you sell puts, you have to have the money aside just in case you have to buy the shares. So that's that. I have a solo put credit spread, and this is basically the same thing, except you don't need the money to buy 100 shares. And what you do is you sell a put just like I did that first time with the $6, but instead of needing $500 just in case I have to buy these, you buy the option below it at the $4 strike price. So I only have to use $100. So instead of needing $500, I only need $100. Basically what that means is if the price does fall below and I do have to buy the shares at $500, this contract, I'm going to sell it back for $400. So the difference between 500 and 400 is 100. So I need $100 to do this option, and I got paid $35. So I ended up making pretty good on here, more than I did selling the naked puts straight out. But the reason why it was like that is because there's more time on this contract. So the more time that there is, the higher the contracts are going to be valued. The closer it gets to expiration, especially if it's not close to your strike price, then the value of the contracts are going to go down. So that's just a little extra stock market strategy. If you're still confused, go check out some of my videos selling covered calls and naked puts and doing credit spreads. So that's basically what I did here for this play. And if I was to close this right now and pay $13, then I would make a total of $22 off this trade out of the $35 that they paid me up front. So I got paid $35. I would use $13 to close it, so that would just net me a realized profit of 22 bucks. But I'm going to let this thing expire worthless. Hopefully on Tuesday, I'll be able to buy more puts and generate more income that way. And this is just a fast, quick way to generate income. Obviously, long-term investing, you make more money. So that's why I have these shares down here, and we're going to get to that in a quick minute. But let me go into this Apple play. This is a debit spread that I got into. So I paid $220. So the opposite of getting paid up front when you do a debit spread is you pay. So you pay a debit to open this trade, but the opposite happens. So when I did the other one, I used $100 to make $40. So in reality, I risked 60 bucks to make 40. When I do it this way, I I have the potential to make $500 because that's the difference between these two strike prices. So $500, and I paid $220. So I'm gonna take $220 to make $280. So you use less money to make more money. This was an okay investment. You obviously want to spend less money to make more money, but if I wanted to just buy this contract straight out without having to do a spread to maximize my gains, then I would have to put up $1,700 to do this, and I didn't want to do that. So I wanted to, because I have a small account, I wanted to use less money and still be able to get into that option. And basically, this is basically a leap option. So when you sell options, you either have to have the cash to buy 100 shares or you have to have 100 shares available. When you buy options, it's just a contract it's just a contract giving you the right to buy or sell shares at that price. So you don't actually have to buy or sell the shares. It just gives you the right to sell somebody else those shares at that price. So you pay the premium, and if the value of Apple goes up, right now it's at 127. So if it goes up past 130 or 135, the value of my contract is going to go up, and I can show you that right here. If I go to those contracts right now, um, if I was to buy this one for 17.98 and Apple goes up, let's say $5. If Apple's at 127, if this goes up to 132, so let's just add $5 to this, so it go down to 125, then that price would become $2,000. So I pay $1,800 for the option. If Apple goes up $5, I can make about 200 bucks. So you want to hold this for the long term, because the higher the price goes, you can see that these get more expensive, and you're just selling it at the more expensive price. So if you were to do a leap option without the spread, that's how that would work. But I did it a spread because I have a little bit of money and I don't want to put my whole portfolio into one play, because if it goes in the opposite direction, there goes my whole account. So if you want to be a long-term investor and you don't want to put that much risk in it, you just buy the shares straight out. And that's what I'm doing down here with this Apple right here. I only have $42 of my own money in it. And this is money that I made by doing the options. So I took money that I made from option selling and I used that to get into a long-term position in Apple. So I wanted to buy shares today, but I didn't get a chance to. So on Tuesday, when the market opens up, I'm going to use the money that I made, probably the $40, to get into a bigger position in Apple. And this is just long-term. So I'm not planning on selling any of this anytime soon. I'm just going to hold it probably forever and just let it grow and continue to grow. So right now I'm only up $1.98 off of my $42, but the more money that I have in there, the more money that I'm going to be able to make on my return. So whenever I decide to sell my shares back to the market, that's when I collect my profits. So that's long term, so I don't really plan on selling. All I do is planning on getting more into Apple, and I want to use money that I make in the stock market, so not using my actual money. So this has been a free investment ever since the beginning. UNH is my health sector, so like I had said, you want to make sure that you're well diversified, so you're in different sectors. This is the healthcare services. So this position is up pretty good. I'm up $4.56. It came down, so it actually used to be more than that, but I have $100 in here. So if UNH ends up coming back down, I might get into my other half. I only want to have at the most $200 in each position. That's because I don't want to have more than 10% of my portfolio in one stock. That way, if the stock goes down, just like AT&T is right here, if I were to put all my money into AT&T, I'd be down $851 if I bought 100 shares. I'm trying to make sure that not my whole portfolio is in one stock. That way, if it goes down, then it's not killing my whole portfolio. As you can see right here, DraftKings, I'm up 15 bucks. So this is definitely helping my portfolio stay up. And basically, I bought 2 shares at 53 bucks. And then DraftKings went down. So once it went down to about $45, I decided to get fully into it. So I put the other $100 into it. So now I'm completely in DraftKings. And because DraftKings is now back up to basically the price that I bought at in the beginning, the last 2 shares that I bought at $45 are up about $8 each. So because I waited to get into more shares when it dropped, basically going on sale, now I'm actually up $15, where if I would have bought all 4 shares at 53.46, I'd only be up, 12 times 4. So I'd be up like 48 cents. So just the fact that I waited to get more shares, I'm up more money in my position. So if I sell these, I made a total of 15 bucks. So there's that. And then my Bitcoin right here. Bitcoin's been going down lately people are selling their Bitcoin or just collecting profits. Right now it's at 36,000, so it's still pretty good, but it did get up to 42,000. And basically what I'm doing here is I got my $200 position in there, and once Bitcoin reaches $250, I'm selling back $50 worth of Bitcoin. So I'm trying to collect $50 every time this thing goes up to 250. So right now it's down. If it continues to go down, I might put more money into it just to get this back to 200. And then when it comes back up, I can make my 250 a lot faster. But for the meantime, I'm just going to hold it. So right now it's below 200. So that's the pullback that we're on. But I had put $200 in there and I collected enough money right here. I actually collected about a little over $100. So I did put 200 in here and I've been collecting profits. So I only have $125 of my actual money in here, and then about $50 is profit still. So that's just a long term also, because Bitcoin is expected to reach, crazy numbers. So I'm holding this for the long term. So if anything, I'm going to be both shaving money off or adding money. This is a small account play because obviously I can't afford a Bitcoin. So as long as Bitcoin continues to go up, I'll be able to collect my money. So I'm basically collecting profit as it makes money and just securing money. And so I can use that because I want to pay off my debt faster. So I'm trying to get things paid faster. So that's my positions. If you guys have any questions on any of that, please leave a comment down below. I'll answer that in the next video, or I'll answer that down below in the comments. Hope you guys have a good weekend, and I'll see you guys on Tuesday. All right. Peace.